The global economy is currently missing 14 million barrels of oil every single day, and the central banks are completely trapped. Forget the AI hype, we are entering the era of the sovereign asset. Let's dive right into the raw data shaping the highly volatile global economy of mid-2026. Welcome to The Explainer.
Right off the bat, we're dealing with a truly staggering number. The global economy is missing an unfathomable 14.4 million barrels of Gulf oil output, and that is happening every single day. This isn't just some minor supply chain hiccup that'll resolve itself next week. No, this is a catastrophic logistical asphyxiation that is fundamentally altering global markets as we speak.
Because of this massive shock, we're witnessing a structural paradigm shift. Look, while the whole world has been totally distracted by the AI compute contest, institutional money has been quietly, yet aggressively, abandoning traditional portfolios. Smart capital is rotating out of the usual stuff and pouring directly into physical, inflation-proof assets. We're talking about the era of the sovereign asset.
Now, real quick before we unpack these numbers, I need to remind you, the following macro analysis is for informational purposes only and does not constitute financial advice. The geopolitical landscape is highly volatile. Assess your own risk before reallocating capital. We are currently navigating an unprecedented, no-rules world right now, and strategic discipline is absolutely your best defense.
Okay, let's get into Section 1, the missing 14 million barrels.
Just think about the sheer velocity of this drop. Global oil supply has absolutely plummeted, resulting in a catastrophic 12.8 million barrel per day global loss just since February. To put that into perspective for you, that's roughly 12 to 13% of total global consumption just vanishing overnight. And let me be clear, no amount of surge production from places like the US or Brazil can even come close to fully replacing that massive gap.
And honestly, the long-term danger here is just staggering. Even if the Strait of Hormuz somehow magically reopened tomorrow, which is a massive, massive if, we are forecasting a cumulative deficit reaching 900 million barrels by September 2026. We're literally drawing down global inventories at a record pace of over 100 million barrels a month right now, just to keep the lights on.
So what's the actual result of all this? Well, this isn't just delayed consumption anymore, it is active demand destruction. Petrochemical feedstocks down 700,000 barrels a day. Aviation demand is totally crippled. Downstream producers over in Asia are literally forcing curtailments because they just can't source alternative feedstocks without paying absolute exorbitant premiums. And Brent crude, it's been violently swinging between $106 and $138 a barrel. We're looking at a complete disruption of the global industrial baseline.
Which brings us to Section 2. Central banks are trapped.
Right now, we're witnessing what economists are calling an active hold. Major central banks have essentially frozen their policy rates. They are completely 100% paralyzed by a classic stagflationary shock. That's a brutal scenario where economic growth is slowing down to a crawl, but energy prices are just rocketing upward.
So the absolutely crucial point here is this stagflationary dilemma. They're trapped. This conflict in the Middle East acts exactly like a massive regressive tax on the entire global economy. Think about it. If central banks hike rates to fight this energy-driven inflation, they risk totally crushing whatever tiny bit of economic growth is left, plunging us into a global recession. But if they cut rates to try and stimulate that growth, they supercharge the inflation crisis. They are well and truly stuck between a rock and a hard place.
Let's move on to Section 3, the Stagflationary Divergence.
When we look at the data, it's clear the global monetary system has become completely fractured. The old era of synchronized global policy, yeah, that's dead. The U.S. Federal Reserve is holding at a restrictive 3.5 to 3.75%. Meanwhile, the Bank of Japan is actually feeling heavy hawkish pressure to hike rates just to defend its currency against these wild energy shocks. And then you have the People's Bank of China moving in the complete opposite direction, providing structural support to desperately escape a deflationary trap.
You're seeing this massive divergence play out in real time. The US is currently insulated by this huge AI capex boom, a massive injection of consumer tax refunds, and really robust domestic energy production. They're a total outlier right now, actually projecting 2.6% growth. On the flip side, energy-vulnerable regions like Europe and Asia are taking the absolute brunt of the shock because they rely so heavily on those disrupted Gulf supply chains. And hey, if you want to survive the greatest structural wealth transfer in modern history, hit subscribe right now. We track the raw institutional data the mainstream media ignores.
All right, Section 4, Era of the Sovereign Asset. This is where it all comes together.
So you really have to ask yourself this. When traditional portfolios, the standard mix of stocks and bonds. When they face systemic inflation, heavily fractured supply chains, and absolute policy paralysis from the world's central banks, where does the smart money actually go?
Well, it rotates directly into physical sovereign armor. As of mid-May 2026, the spot price of gold surged to an absolutely astounding $4,550 an ounce. Now, traditional financial logic will tell you that when interest rates are high, non-yielding assets like gold are supposed to suffer. But guys, that correlation has entirely decoupled. We're in completely uncharted territory.
As the institutional data clearly shows, the geopolitical risk premium has just overwritten everything else. Central banks, massive sovereign wealth funds, family offices, they all realize that physical gold and silver are no longer just speculative commodities to trade. Not anymore. They are now a necessary, critical mechanism to escape the volatility and sheer vulnerability of Western monetary structures. It is pure, unadulterated sovereign armor.
Let's look at Section 5, draining the COMEX dry.
The raw fundamentals happening in the silver market right now are just jaw-dropping. We are officially in the 6th consecutive year of a physical silver deficit, looking at a 46 million ounce shortfall expected in 2026 alone. That brings the total cumulative drawdown since 2021 to nearly 762 million ounces. Because of this, COMEX registered inventories have just plummeted to roughly 315 million ounces. And the real kicker here? Supply is completely inelastic. Since 70% of silver is actually mined as a byproduct of digging up copper and zinc, mining output simply cannot just scale up quickly to meet this sudden, massive monetary demand.
Because of this intense structural physical shortage, silver has violently repriced. We've seen the gold-to-silver ratio compress dramatically. Silver is rapidly shedding its old, boring identity as just some industrial component for solar panels and electronics. Today, right now, it is transformed into a primary monetary asset and a highly leveraged safe haven play right alongside gold.
And finally, strategic discipline in a no-rules world. If we're going to survive the back half of 2026, we absolutely have to recognize this new geopolitical architecture. We are operating in what risk analysts are calling a no-rules world. The old institutional guardrails, they're buckling. We're dealing with unprecedented domestic political volatility in the U.S., a massive global shift toward raw transactional realpolitik, and this constant heavy tension between the incredible productivity promise of the AI revolution and the literal existential threat of total energy insecurity.
The secret to surviving the 2026 macro environment isn't chasing overvalued tech stocks. It's front-running the central banks into physical silver before the massive industrial deficit drains the COMEX entirely dry. So ask yourself, in a world of missing oil and trapped central banks, is your portfolio positioned for the past, or is it ready for the sovereign asset? Want to see exactly how to build an inflation-proof real asset portfolio? Click the video on your screen right now.